12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Bloomberg Quint Live. Gulf Oil reported a steady third quarter earnings. Now, the revenue growth of the company was good, but on the margin front, if you see, the performance was a bit muted. To give us more details on the quarter gone by, joining us now is Manish Gangwal, the CFO of the company. So, sir, to start off with, you witnessed a strong revenue growth in the third quarter. What aided this kind of revenue growth in this quarter?
Yeah, you're right. We had a very good quarter three in terms of our overall results. Our volume growth was around 34% and a revenue growth of 30%. And we had one-time institutional order this quarter, which was close to 3,500 KL. It was a large quantity. But if we remove the impact of that, also our volume growth has been 20%, which is 4x, 5x the industry growth rate. So we had a very good quarter overall. This quarter we also had highest ever EBITDA and highest PAT ever in the history of Gulf Oil. So overall it was a very good quarter led by volume growth.
But I guess this good revenue growth and volume growth has come in at the cost of EBITDA, because if you see your EBITDA margins, they have slipped compared to last quarter. Now this is despite the fact that crude prices were lower in this quarter, which should have aided your margins in Q3. So what led to this fall in EBITDA margins in the third quarter compared to the last quarter?
Yes, so you see, historically we have been saying that we maintain a 16 to 18% EBITDA margin band, but this quarter was slightly below 16% because of the institutional order, which I explained just now, that it was a large order and the margins there are very, very minimal. So if we remove the impact of the institutional order, we are still in that band of 16 to 18%. And the fall of crude prices has a lag effect in terms of their impact on the base oil prices. And as we see towards the end of the quarter, the base oil prices have started softening, and we took a price increase also in our retail channel towards the end of the quarter, effective 1st of December, and that also will play out in the coming quarter. So overall the coming quarter looks much more better in terms of margins as compared to the December quarter, because of the institutional order which was there, and the effect of falling crude and stable rupee will be visible from quarter 4 onwards.
So sequentially your margins would be higher because of stable crude oil prices and because of the price hike that you had taken at the end of the third quarter. So what kind of expansion that we are expecting from in Q4 compared to Q3?
Yeah. We always maintain that we want to deliver 16 to 18% EBITDA margin, and that band will surely be back, because this quarter we are slightly below that band, but we will be again in that band of 16-18%.
Okay. Sir, also if you could give us a breakup on the volume part, like what was the segment-wise volume growth for diesel engine, car and two-wheelers? If you could give us more details on the same.
So all our volume segments have grown double digit, led by personal mobility, where the growth was close to 20%. Personal mobility includes both passenger car and motorcycle oil. But overall, all the segments have grown double digit for us in the quarter.
And do you expect this growth rate to sustain over the coming quarters?
Yes, so we have been delivering 3x, 4x the market growth rate. The lubricant market in India is growing at 3 to 4%. And we have our CAGR growth for last 8 years have been 12%. And this quarter and YTD also 9 months, our growth is 21%. So overall we have been delivering 3 to 4x the market growth rate, and we are quite confident that we can continue delivering that kind of a growth in the coming quarters as well.
Also, sir, if you could share some details on the plant capacity utilizations that were there in the third quarter, and what is the exit rate that you're seeing for the financial year 2019? When it comes to plant capacity utilization?
So our Chennai plant started production from April onwards, and now it's running at close to 60% capacity. As we move forward with the kind of volume growth we are seeing, we are inching towards higher capacity utilization in the next year.
And what will be your capacity utilization rate, if you could give us a range where it could be?
See, we had a plant in Silvassa which was 90,000 KL capacity, and the new Chennai plant was at 50,000 KL capacity. So both put together we have 140,000 KL of capacity at our disposal. out of which the current year the volume is around 100 and we are likely to have close to 110 115,000 KL. So we are already at close to 80% utilization overall in terms of overall capacity, and with the some of the volumes going from Chennai plant to even eastern India, we believe that the utilization at Chennai plant will improve further. So overall, with our volume growth, we will inch towards maybe closer to 85-90% capacity utilization.
Lastly, sir, do you see your volume growth guidance that you have been maintaining like 3 to 4 times of that of the industry rate? Now that could come down because we have been seeing a slowdown in the auto sales volume?
So factory fill volumes are slightly impacted, but we have close to only 10% of our volume coming from factory fills. As the first vehicle move out of the factory, the first fill volumes are slightly impacted as of now. But we see that there will be a pre-Euro 6 buying which will help us towards from second quarter onwards next year, and overall the full year impact should be minimal. But the retail sales and franchisee workshops, industrial sales for us, all are growing very healthy rate. So overall impact will be very minimal of this current auto slowdown.
Also, sir, just the last question before, any new tie-ups that you have done in the third quarter?
So we had a tie-up with Tata Motors for passenger car segment in the retail segment, and that's very encouraging for us because the market share for them is going up, and we have a low market share in passenger cars currently. So the tie-up is definitely going to help us in our focus segment of passenger car.
Well, that would be all, sir. Thank you for speaking to Bloomberg Quint. Thank you for your time, sir.